Hello, everyone, and welcome to the 9:30 a.m. session, AI for Dynamic Markets. We're joined by Douglas Maxwell Hamilton, Managing Director of AI at Nasdaq. Welcome, Douglas, and thank you for joining us.
Thanks, Aaron, for having me. All right, so I guess we'll just launch into it then. So as Irina mentioned, I'm Doug Hamilton. I head up AI research for Nasdaq. And today we're going to talk a little about Nasdaq's vision for the future of dynamic markets and how AI is helping us to extend the broad notion of the highly efficient, deeply liquid markets we see in financial markets to alternative assets as well. So as we often do, we like to start off doing a little quote mining. So we'll talk a little about what Paul Daugherty had to say, who's the CTO, CIO at Accenture, noting that in 2019, businesses that don't deploy AI and data to help them innovate in everything they do will be at a disadvantage. What we found a little interesting when doing this round of quote mining is that in 2015, 16, and 16, when we were doing quote mining, we found is everybody making aspirational statements. In 17 and 18, everybody was making these statements about how the success and profit they were finding from AI. And in 19, that we were about to miss the boat. When we look at that combined with, of course, our current situation where everything in life is becoming more digital, what we've really found is that AI has gone from, in 2019, this is an exciting technology that we must be using for our digital platforms that this really is the new normal of digitization and smart interaction with our devices. So one of the things we've also found over the last few years is, in 2015, 16, 17, when we were talking about artificial intelligence and deep learning, we talked about it as a set of esoteric algorithms and that our business partners frankly didn't care about, or very arcane maths that nobody understands. That, suffice to say, didn't go very far. It was not a good way to communicate what we could do. Instead, what we found is that really, when we think about the landscape of artificial intelligence today in 2020, which is quite deep and quite mature compared to where we were just 5 years ago, we see AI as enabling 4 different capabilities that we didn't have in traditional software development. The first is control. In there, we mean the ability to make real-time decisions. This is best seen in our daily lives in game-playing machines like AlphaGo. Deep Blue would certainly count as this, as well as applications in self-driving cars and all sorts of areas. Certainly, it sees a lot of application in modern video games, which is kind of an interesting test bed. The second area we see is perception, and this is how we see machines interpret the world. We've typically called this things like image recognition or natural language processing, but really it's any time we're using a machine not to predict the future, but to predict something about the present that's difficult to articulate, difficult to code for, but easy to know when you see it. And again, the best example we see here in our day-to-day lives is probably facial recognition. The area that people are most familiar with machine learning from is prediction. And prediction really enables 2 different things. One is we can talk about how we can use machine learning to predict the near-term future events with some level of accuracy. We also talk about it as a way to help us find hidden relationships between things that we wouldn't have thought of before. Because we can use those to predict the future. There might be the near-term future with some level of accuracy. There might be some relation between them that we can exploit in the present. And then finally is interaction. And this really is these bevy of new devices that use a number of the types of artificial intelligence machine learning that we've just described in order to allow us to interact with devices in new and novel ways. Of course, at Nasdaq, we have very little interest in things like facial recognition for perception or playing AlphaGo. And instead, we try to reimagine these capabilities in the context of financial markets. So we found that control systems actually have really deep applications for vetting and understanding alternative data. Because if you want to understand if alternative data is valid or useful for the investment community, you should be able to build an investment strategy on it. We use predictive analytics in understanding how assets will flow throughout the markets and how volumes change on a daily basis. We use various types of perceptive analytics or perceptive machine learning in areas like trade surveillance to understand e-coms, that's communications within banks, understand find bad actors and instances of market manipulation. And increasingly, we're beginning to leverage it in the anti-money laundering space as well. And finally, within interactive AI, we're finding lots of applications within our investor relations team, where we're able to help investment relation officers interact more simply and easily and better understand the market through various sorts of interactive AI. But the bulk of what we really want to talk about today is how we can leverage this AI's adaptive and flexible nature to not just improve Nasdaq's bottom line and how we deliver products to market, but also how we can use it to take our notion of highly efficient, deeply liquid, safe and transparent pricing that occurs on our markets to non-financial markets as well, which historically have been less liquid and less transparent. And you might think to yourself, I buy things every day, so why on earth do I need digital markets and highly efficient markets to do this? So I like to think about buying a car, which is a thing we all do semi-frequently in our lives, and probably will do it for the foreseeable future as well. That's a pretty huge pain in the ass to do. For example, if you want to buy a car, what you do is you go to a dealership, you talk to a salesperson for a little while, and you haggle over the price of the car. Then you talk to another salesperson who invariably says at some point they have to talk to their manager. They don't actually talk to their manager, and comes back with a price. And by the end of all that, you go home, you're exhausted, you're trying to figure out if you want the car or not. And grim reality sets in that, oh no, all I've done is learned about the price of one car at one dealership. And if I want to be a savvy person who's shopping for the best price, I have to do it again. And then there it is. And again, and this process can take weeks and weeks just to purchase a car. So how would this be different if we had a centralized market where all these trades and transactions would occur? Well, for you as a buyer, you could very easily see the price movement that's occurring on cars and on a particular car and the prevailing price that it exists at, so that you know you're getting at least a fair deal reasonably often. From a seller's perspective, it increases the velocity at which they can sell vehicles. It certainly changes the relationship between the buyer and seller in some meaningful way, but you're able to also sell those vehicles much more quickly. From the perspective of both fleet managers and the dealership owner, there's other advantages in how they manage their inventory as well. But effectively, what we see as soon as we enter a market ecosystem, a centralized two-sided market ecosystem, rather than kind of these distributed one-off sales floors, is that the transparency of price discovery increases enormously and is to the benefit of all players. And the reason we see this really has to do with what we call the efficient market hypothesis. I'll try to go through this reasonably quickly because we only have 20 minutes. We could spend hours talking about this today, but instead we'll talk about these three forms. And really the forms of the efficient market hypothesis I'm going to talk about today are in the context of modern financial markets. And there's certainly some argument to be had over how efficient modern financial markets are, but generally speaking, they fall into one of these three categories most of the time. The first is the weak form, and this is kind of boring. All the weak form really says is that the price that you see on the market is probably about the right price, and it's incorporated all the historical price movements. The semi-strong form, which is that the price that we see incorporates all public information. A great example of this is that when you go and have an earnings beat, or even just an earnings call in general, the price that you see for a particular stock doesn't swing wildly. And that's because other public information has informed us roughly about what your earnings are going to be. And so you need to beat the expectations rather than merely meet them in order to see a large jump in valuation. But you might think, okay, well, maybe that's not public information. Maybe really all that is a bunch of insiders working on a single street or a small area of a tiny island in the northeastern portion of the United States. They all kind of know each other. It might be some insider knowledge that lets us actually take care of that. And that's where we get to the strong form. And the strong form is where the really spooky and kind of cool action occurs in markets. And this says that all information, both public and private, are incorporated into the market price. even information not known to insiders. My favorite example of this that occurred over the last few years is in the 2016 election. Two people that I'll use as my stand-in for the ultimate insiders on this are the editorial board of the New York Times and the Princeton Political Science Department, both of whom on November 6th gave Donald Trump less than a 1% chance to win the presidential election. And we should note it's less than 1%, while a bunch of degenerate gamblers on the internet gave him about a 33% chance. And 33 isn't 50, but it's a hell of a lot closer than less than 1%. And really what this is saying is that our market prices have not just information about the things we know, but maybe also about some of the things that we don't quite know. So wherever we think modern financial markets fall in this framework, the one thing we should agree most on is that many markets don't. And when we think about market efficiency at Nasdaq, we think about it in terms of two things, which is liquidity versus frictive, how frictive versus liquid the market is, and how opaque versus transparent the price discovery mechanism is. We talk about modern financial markets, we are high on that scale in both categories, highly liquid and with high levels of price discovery transparency. If we compare that to our earlier example of car buying, modern analytics companies like car gurus have certainly made price discovery a little more transparent than it has been in the past, but the process is still pretty frictive. We can also think about going to our local farmers market and think about prices there. It's never really been clear to me why the egg I buy from a chicken at a farmer's market costs so much more than the egg I buy at Stop and Shop. But nonetheless, it is a little bit, there's so many prices you can compare that the price discovery mechanism is not completely opaque. And because again, there's so many ways to move in and out of the assets you buy, or at least compare them, it's a reasonably liquid market as well. However, we don't just use markets, of course, to price financial assets, buy cars and buy overpriced eggs. We also use them for other purposes as well that are probably a little more important to our day-to-day lives, like figuring out how much we're paying for rent. The real estate market, and particularly the rental market, is one that is highly opaque and highly frictive, and one where where price discovery is difficult to understand for a renter. And of course, the most illiquid, opaque, and frictive market probably in the United States, healthcare, where neither the buyer or seller can tell you what they want, how much, and how much it will cost, and you only get billed after the fact. It is a deeply frictive, highly opaque market that it just is probably one of the least efficient ones in the country. Now, with digitization, we've seen a rise of a number of new and novel asset marketplaces. One of the ones we like is StockX, which is an online marketplace really for sneakers. So if you want the latest Jordans, you can go on there and figure out what they should cost. Interacting or buying them with a two-sided marketplace with a certain number of bids and asks at each price level and a certain availability that exists. And this is really how we sort of see canonically the typical marketplace for non-financial assets playing out. That you'll have a two-sided marketplace of buyers and sellers who interact with each other through prices and asset types. We've also seen the rise of these two-sided markets or marketplaces for sporting events and other ephemeral goods. So SeatGeek's an excellent example here, where you're able to quickly assess seats for sale for an event. Well, maybe not now, but you used to be able to. Find the people who are trying to sell it for the lowest price, or sell it for the lowest price, and decide if that's a price you want to pay. And they do a pretty good job actually of lumping merely similar assets, that is seats in a certain section, rather than the same exact asset, the same seat, into a tractable number of categories for you to peruse. For our part at Nasdaq, we've actually been engaged in powering two other new and novel markets, including Skytra, a derivatives market for airlines, so that they can hedge the risk associated with loading an airplane with people and sending it somewhere, because 90% of their tickets are sold in the last 2 weeks before a flight actually moves. So it's not easy to always. So there's a high level of temporal revenue volatility associated with airlines already. And of course, one of our other ones that we've recently launched, the football index, where investors, definitely not gamblers, investors can buy and sell shares in the actions of professional footballers or soccer players. Digitizing markets actually has a lot of other advantages as well, besides just the efficiency and price transparency. It turns out that out of the back end of these markets comes a lot of data that can allow us to both provide customization and personalization for interacting with these markets, allow us to learn things about the broader economy by understanding cross-price elasticity for almost any number of goods that we would serve on, and allow us therefore to better understand the market, to understand how liquid markets need to be for non-financial or ephemeral or physical goods in order to kind of become efficient. And then for people on the other side of the world who aren't just the buyers or people trying to understand and invest, it can help you make better supply chain and inventory management decisions and allow you to engage in better risk management as well. So, for example, if we have a financial market, if we go back to our car example, it's not difficult to think about how we can build derivatives or contracts based on those instruments that have real world applications. So if we think about our car market, we could certainly have an option market on that car, which would be a lot like a warranty market. And it could tell us, and by understanding the warranty market, we could probably understand something, depending on how efficient you think that market is, about the likelihood of the particular car you're interested in of being a lemon. By the same token, we could stand up a futures market for the car that you're looking at, which actually sounds a lot like a leasing market, but a little more, I guess, transparent and reliable and liquid, where we could understand the futures curve for that particular type of car. And based on the futures curve, we'd understand people's expectation of the car's depreciation and cost of maintenance associated with it. And this sort of information really is the kind of information that is hard for buyers to get today, hard for sellers to get today as well, that markets just provide in spades simply by existing and allowing people to interact on them. So I know we're short on time. I'll try to run through this last section very quickly. So what do we need? So where does AI come in? Well, AI really comes in because all markets have similar needs: to search, compare, select, and then price an asset. And this is where AI and machine learning can now be helpful to meet the needs for new and novel asset types. And the way I describe this often is that the following problem: buying Apple versus apples. If I need to buy Apple, I log on to E-Trade or my brokerage of choice. I type in AAPL, and $200 later, I have a share or so of Apple. If, however, my wife asked me to go buy apples, and I go to the market and buy apples, I know this is much harder to do because I always do it wrong. There's simply way more variation in what constitutes an apple, both in size, shape, quality of the apple, and price, than we would ever see in the actual stock apple. And of course, AI can help us cut through the fuzzy nature of the world by making those sorts of fuzzy connections and interpolations. So in fact, finding and comparing similar items is something that we do very often with AI, right? If you log onto your Netflix page, what they're doing is they're finding semi-dissimilar things, which are shows and movies, comparing them, and then putting them into very similar buckets. It turns out the process of putting things into similar buckets is not so dissimilar from trying to find similar things and putting them onto consolidated order books. By the same notion, we need to have a sense of pricing. And this is an area where we have to discuss very briefly a tension that occurs, which is that when we talk about low markets with lower liquidity and more complex parameterization, market pricing can be more erratic, right? AI and statistical computing sort out the true and spot prices from fair or equilibrium prices. True prices and spot prices being the price we see on the market or the midpoint, and the fair equilibrium being some notion of what is a good price to pay for an asset. So what we'll quickly say here is that the price on the market is going to tend to be more correct than whatever your algorithm says, but your algorithm certainly can smooth out some of the worser excesses of behavioral biases and run-ups that may occur in market-based pricing. By the same token, one of the other things we didn't talk about very much with the car example is that oftentimes with less liquid assets that are parameterized in complex ways, we have to engage in negotiation. And again, this is an area where we see opportunities for AI to come out and help both buyers and sellers negotiate. As a buyer, you don't buy these things very often, and you might want help negotiating a fair price or a fair position. As a seller, you might want to negotiate with everybody, but don't have time to, right? You might want to only negotiate with somebody buying a fleet of cars and not necessarily somebody buying an individual one. However, AI and AI-based methods can allow us to engage in either machine-assisted or machine-directed price negotiation in the post-trade landscape. And this is an area where we really see federated learning playing a large role because, of course, as a seller, you don't want your negotiation secrets to be leaked. And the type of privacy preservation that we see in federated learning really helps with that problem. The last area we'll talk about is, I think, the most exciting thing for Nasdaq, because of course in all these markets we're talking about similar sets of tasks in a highly disparate domain space. And here, really, the technology that has us most excited is transfer learning and the rise of transfer learning, where we're able to take a financial corpus and train a model. So, for example, a negotiation bot for market one, and then because a similar task exists maybe from our financial space to our car space, or from corporate bonds, let's say, to cars, we can find a totally new domain, car purchasing, and rapidly create a negotiation bot for our new domain, our car market. And what this allows us to do at our core is transfer learning from areas where we have considerable amounts of data, like, let's say, the US equities exchange that we run that does $7.5 trillion of transaction annually, to areas where we don't have as much data, whether that's smaller financial markets around the world, or new and novel non-financial markets as well. So those are just a few of the examples of how AI is using Nasdaq to create the next generation of dynamic markets. And with that, I'll pause to take questions. Thank you.
Thank you so much, Douglas. That was absolutely fascinating. I didn't know a lot about these applications of AI in the financial market. So thank you for that comprehensive presentation. And just a reminder to our audience to feel free to send in some questions on Slido. In the meantime, I guess, yeah, so while we're waiting for the audience to contribute questions, thought I'd just kick off discussion with one of my own, which is, you talked about so many different applications. What is something that really surprised you? I'm guessing you had a lot of experience, pre the AI world, and you mentioned that 2020 is a new normal. So what's an area where you were just completely blown away by the capabilities of AI?
Yeah, so I think the first time I was really shocked by the capabilities. In all fairness, I actually haven't seen a lot of the world before AI. My professional career really started in 2012, so not that long ago. But the first thing I did that blew me away is we were working on this project related to alternative data, which is data that is not typical financial data. Think satellite images of shipping lanes. And the question is, you have satellite images of shipping lanes. Is that interesting at all? Because it's not clear that it is. In the words of paraphrasing one of our clients, alternative data is expensive to onboard, expensive to work with, and then it's almost all trash. So you have this massive amount of data. You got to figure out what's interesting. And we were able to leverage AI to build a method to automatically generate trading signals on data that we'd never seen before. It's like, oh, that seems useful and cool. And all of a sudden, we were able to very rapidly figure out whether or not these disparate sorts of data sets coming from all sorts of different domains had any value or not. I think that was the one that really just touched me off and had me realize that the value of AI is not necessarily just in superhuman performance. It's really that scale element that it enables that we could never get to otherwise in how we understand the world.
Absolutely. Okay, so we've got a question, and this may be sort of, I'm not sure I call it run-of-the-mill, but it's a question that people often ask about in my markets. So it is, which AI methods have you seen that work best for price prediction?
Yeah, so that's a really interesting question. I would say the methods that I've seen that work best are reinforcement-based methods. I have a very lengthy talk about that, actually, that I used to give a couple of years ago. And the reason for this is many people think that your goal really when you talk about investment isn't price prediction. It's building a portfolio that produces returns. And if all you're doing is predicting prices, let's say whether they'll go up or down, you're going to be at the mercy of something called the symmetry of return. And that can be pretty disadvantageous to you. Reinforcement learning, though, helps us really go from price prediction to portfolio generation. So I'd say that's the one that works best. Now, with that said, for those of you thinking about using AI to power your own portfolio, you should know that the underlying assumptions of artificial intelligence are not particularly amenable to highly evolutionary or highly adversarial world landscapes like stock investing or like investing. So be careful.
Thanks for that very practical advice, Douglas. That's something we definitely have to keep in mind. Well, we've got so many questions flowing in, and we'd love to just continue the discussion, but unfortunately, we're out of time. So, audience members, reminder: please feel free to continue the chatter on Slack. I'd love to see answers to these questions myself. Doug, thank you again. We really appreciate your time.
Thank you, Irene. I was glad to be here. Thanks.
Thank you. And audience members, if you want to join us for the next session, make sure to go ahead and follow the link through. See you all there.